Hey everyone, welcome to today's Explainer. We are diving into a really fascinating data set that's going to be incredibly valuable for anyone navigating the polymer space right now. We're unpacking the global ethylene vinyl acetate, or EVA, market trends for June 2026, and we're pulling this directly from the latest weekly report and future trends analysis by Polymer Bazaar. Look, if you're involved in manufacturing, procurement, or market forecasting, you already know just how volatile these material costs can be. So we're going to strip away all the noise and give you a clear, data-driven look at exactly where the market is today, and more importantly, where it's heading tomorrow. Okay, here is our roadmap for today. We're going to cover a sluggish global market, price drops in the West, Asian supply and Indian offers, feedstock and geopolitical factors, and finally, purchasing recommendations. Let's jump right in. Part 1. A sluggish global market and why demand is shrinking everywhere. So before we start crunching the regional numbers, we really need to look at the main engine driving this market right now. Or, well, the lack of an engine. It's a dull demand cycle. Converters, the businesses actually taking this raw material and turning it into finished goods, are basically just sitting on their hands. And why? Simply because their finished products just aren't selling at the pace they expected. When your outgoing sales are slow, you're obviously not going to buy more raw materials, right? You hit pause. And that hesitation trickles all the way up the supply chain. It shifts the leverage squarely over to the buyers, leaving us with these massive, honestly kind of excessive global stockpiles of EVA. Moving on to part 2, price drops in the West, the US and Europe. Look, when demand dries up, prices correct. And in the US bazaar, this wasn't just a gentle little dip, it was a massive haircut. We're talking a drop of $270 per metric ton. According to Polymer Bazaar, both domestic and export demand in the US have shrunk pretty significantly. Buyers wanted price cuts, and wow did they get them. Prices cascaded all the way down to settle at $1,375 free alongside ship in Houston. When you see a sudden, steep drop like that, it tells you exactly how aggressively suppliers are trying to lure buyers back to the table. And it's practically the exact same story over in Europe, mostly thanks to heavy retail stockpiles. Suppliers are slashing delivered duty paid, or DDP, prices across the board in Northwest Europe. Low-grade material, that plummeted by €350, dragging it down to $2,000 per metric ton. Medium and high grades took a major hit too, dropping by €300 and €205 respectively. So these aren't just minor fluctuations. These are deep, structural discounts driven completely by stagnant retail stock, meeting a totally dull demand. All right, part 3, Asian supply and Indian offers. Eastern market nuances. So while the West is basically drowning in oversupply, the Chinese bazaar is stuck in total gridlock. It's like a perfect storm of nothing happening. On one side, you've got tight supply crippling output because of ongoing maintenance plant shutdowns. But on the exact opposite side, you have that same dull demand we're seeing globally. When heavily restricted supply meets absolutely non-existent demand, you get static spot prices. Right now, they're just holding firm at 9,800 RMB per metric ton. Basically, nobody, not the buyers, not the sellers, has enough momentum to actually move the needle. Meanwhile, if you're the one managing procurement logistics for the Indian bazaar, you're seeing some highly specific import offers rolling in for July. For instance, LVS 430 grade is sitting right around $1,360 to $1,365 cost, insurance, and freight at Navasheva. But Chinese suppliers are playing incredibly aggressive right now. They're offering Baofeng and ZPC grades at a super competitive $1,280 CFR across major ports like Mundra, Navasheva, and Chennai. And they're putting highly detailed offers on the table. We're talking 25-kilogram bags, letter of credit at site. They're literally pulling out all the stops to capture whatever tiny bit of buying interest is left out there. Which brings us to part 4, feedstock and geopolitical factors, the macro view. We spent a lot of time looking at localized spot prices, but to figure out where the market is actually heading next, we have to look at the global variables, the stuff that dictates feedstock costs right at the source. And that leads us to the ultimate million-dollar budget question: will these low prices actually last? I mean, sure, it's great that prices are dropping in the US and Europe today, but is this just a temporary blip, or is it our new baseline? To figure that out, we have to look at international production costs. And the answer really comes down to this sequential chain reaction. First off, we've seen a recent easing of geopolitical crises, and as neutral observers of the data, we just know that this easing has a direct, immediate impact on the supply chain. When global tensions cool down, feedstock availability naturally goes up. More raw material means international production costs across the various bazaars start to fall. And the final step in that chain for you, the buyer? The market is heavily anticipating that the next round of export offers will likely be quoted even lower. And finally, Part 5. Final Purchasing Recommendations. Your June 2026 Strategy. All right, let's turn all this data into something you can actually use. Since we're expecting export offers to keep dropping, the Polymer Bazaar report is incredibly clear on this. Their exact advice? Therefore, we recommend continuing with need-based procurement. Basically, now is not the time to back up the truck and aggressively restock your entire inventory just because prices look like a steal compared to last quarter. The trend lines are screaming that they could get even better. So the smartest strategic move right now? Hold off on stockpiling. Buy exactly what you need to keep your immediate manufacturing running, and keep your powder dry so you can capitalize when those export prices drop even further. But, and honestly, this is a massive but, we have to leave you with one final critical warning from the report. Market forecasts are fragile. Yes, there have been ceasefire announcements, but we absolutely have to keep a close eye on the news coming out of the Middle East. Any sudden escalation in tensions there will immediately shock the energy sector. And if that happens, this nice, comfortable buyer's market we've been talking about will flip upside down literally overnight, completely scrambling every price forecast out there. It's a really delicate balancing act, right? Capitalizing on current trends while staying fiercely awake to global shifts. So as you map out your June procurement, you have to ask yourself, are you positioned to take advantage of today's low prices? And maybe more importantly, what exactly is your pivot plan if those geopolitical tensions suddenly flare up tomorrow?